In this presentation, we will take a look at the common managerial accounting type decision of sell or process further, which is very similar to the decision of should we scrap or rework. So the question being at this point, should we sell our inventory at this point in time, or should we process it further and sell it after that processing at a higher dollar amount, but incurring the costs to process further? This is going to be the data that we're going to have. We got the units produced, 11,200. The total costs are going to be 168,000. Sales units as is, we can sell them for $3 per unit, or we can repair and sell them for $7 and an added cost of 19,200 in order to do this. Now again, we have a repair item here. It says that we are going to repair these items, and these items have already been produced. It's going to be the same type of scenario if we had something like we're going to produce it up to this point in time and decide if we're going to process it further. For example, we might have something like coffee that we process to the coffee itself, the coffee beans, and then the question is, should we process it further to have the coffee grounds and then sell them possibly for a higher price? The point is, up to this point in time, up to where we have the coffee beans in that case, is going to be a sunk cost, or in essence a cost that's going to be the same under the two options. So if we're talking about a case where we have work that's already been done and it was damaged, and now we want to see if we want to repair it or not, well then that's going to be a true sunk cost because the sunk cost is already there. If we're in the business of selling either coffee beans or coffee grounds, then the costs up to the point where we're talking about the coffee beans is not relevant under the two decision-making processes, because it would be the same. We'd have to have those costs up to that point in either case. So in that way, they're kind of sunk in that they're not relevant to the two decisions. They're not going to be something that will differ between the two decisions as to whether we should stop at the coffee beans, sell them there, or process further to the coffee grounds and sell them at the higher price at that point in time. So the way to look at this, we're going to set up our table. We've got the sell as is, or the process further, and the difference between the two. So if we have the sell as is, we're going to have the 11,200 units. So we've got the 11,200. We're going to say times $3. That's going to be the 33,600 on the revenue side, the sales side. If we process further, the 11,200 times the $7 would be 78,400. 78,400 minus the 33,600 is going to be 44,800. Now, of course, the sales will be higher if we process further, but there's going to be added costs to it. That added cost is going to be the 19,200 to process further. Note that the costs to this point in time are irrelevant. Just like if we were making coffee beans, and even if we're going to make coffee beans into the future, of course, the costs up to the point in time that the split happens between our decision to sell them as coffee beans or process further to grounds are not relevant between these two decisions. And therefore, from this point forward, the relevant costs between these alternative decisions, the sale as is has no more costs. Doesn't mean it didn't have any costs up to this point, up to the 11,200 units if they were coffee beans to make the coffee beans. But it just means that at this point in time, the cutoff where we're making this decision as of, that it's not a relevant decision-making process between these two alternatives. To process further, the costs of processing further are going to be relevant, and that's going to be the 19,200. Difference being, of course, 19,200. The 44,800 minus the 19,200 then is the 25,600. So in this case, then the better option would be to process further, because we're going to be better off if we go from the processing further option.